What we've tried to establish is through that 50% per annum increase in dividends and now in repurchases, a baseline expectation as to where we're going. And yes, our intention would be, as we said in the third quarter, to accelerate and expand on that distribution, ultimately beating the $8 billion target that we set a couple of years ago. We'll need to take it step by step and be based on what we see in terms of performance and development in the early months of this year, whether there's room to expand on that repurchase. But it's certainly our aim to pass along a significant amount of the additional capital we found in our outlook and talked about in the third quarter to investors.
And what's holding you back? What's the concern there?
I think it's just passage of time and performance certainty about the future. I mean, the whole purpose of the repurchases is to allow us to distribute capital, but as long as in our judgment it's prudent.
And trading was sort of a difficult quarter overall. FICC managed to kind of eke out a gain better than a lot of the competitors. What's the outlook for trading, and what are you seeing in the first month of this year?
So you're right. Fixed income and currencies for us at 1% up on last year, which was a strong fourth quarter, was actually encouraging. And to your question, momentum has carried through into 2024. So we've had a strong January. And we also, if you like, think the environment now, finally, after 2 years of going backwards, should be much more conducive to corporate finance activity, financings, equity deals, M&A deals, just because all of the sort of the setup conditions to us are coming
back now?
We do. Yeah.
It's not too early?
No, look, it's been delayed. We sort of thought it would be a second half of last year event. Of course, interest rates and perhaps some uncertainty on the geopolitical side, held activity back. But now with rates declining, I think a better view of the economy and where we're going, the need to refinance against just maturities that are coming, and also animal spirits on the strategic side, we think that is coming back in 2024.
How hard is it to give an outlook for 2024? This is something I feel that across companies, there's a lot of discomfort about forecasting what's happening. Are you confident you can hit $30 billion in revenue? And
we are.
Net income can bounce back?
And we are, and we'll talk to investors about that today. We're going to up our target for the compound annual growth in revenues between 21 and 25 to between 5.5% and 6.5% when we talk to investors. That's against, we traveled this year at 8% and now at a compound growth rate near 7%. So we think it's a continuation of the performance of the last 2 years, albeit with a rotation from interest income-driven revenue growth to more non-interest, so fee and commission income-driven growth.
Of course, all of this will be to the sort of marching orders of the Fed and the ECB. What was your interpretation of the Fed last evening? What do you see rates in the U.S. doing?
Well, look, one thing I'd say before I get to the monetary policy decisions is, at this point, we've significantly insulated ourselves from the variations of monetary policy decisions. So by hedging forward, our rate sensitivity has gone down. And we also see over the coming years the much better environment for long-term rates, even now, asserting itself relative to the hedges we did, 10 years ago. So we do see continued momentum. As it relates to the central banks, it's hard to say. I think our view, if you like, our cultural or philosophical view is that inflation is really unhealthy for the economy, and therefore the central banks should probably err on the side of waiting to ensure that inflation is tamed before taking action. There's, of course, now speculation. Is that March? Is it April? Is it the summer? I think the direction of travel is clear as long as the data supports it.
And in terms of cost cuts, you've announced some job cuts, 3,500. So talk to me about those. Those are going to be all back office. Is there going to be a look at the investment bank? Is that it for job cuts for the time being?
So we have focused our efforts on what we call non-client facing staff, where there's been a significant change over the last several years around internalization of activities, the control investments that we've made, the investments in technology. And so having reached a level of maturity in some of these areas, I think the goal now is to drive efficiency without losing effectiveness. So yes, that's where the staff cuts are targeted. And that's not an isolated thing. We're working across a whole range of of initiatives and dimensions in the company now to really deliver on the expectations we've set around expense management.
But do you think this is the end of sort of job cuts for the time being? Will there be a look at sort of front of the house activities there?
Look, I'd say in the front of the house, the direction has been up, making sure, first of all, that we can service our clients and also, to a limited and targeted extent, grow our footprint. And as you saw in 2023, there were sort of unique opportunities in the marketplace to do that. And by the way, not just in our origination and advisory business, but also in wealth management, also in our corporate bank.